Hey, everybody. Welcome to the What the Wealthy Do podcast, where in just 15 minutes, we pull the curtain back on how the wealthy build wealth and show you how you can apply it to your everyday lives while you're on your wealth building journey. I'm your host, Stephanie Dorsey. I am also the CEO and co-founder of Margins Capital. Margins Capital is an investment firm that focuses on providing women and people of color access to an institutional quality portfolio of alternative investments. And we're finally getting to talk about my favorite thing. Well, we're going to talk about public markets, but we're also going to talk about private capital markets. And we're going to talk about private capital markets for like the next umpteen episodes, probably only 4 or 5 episodes, but I'm really excited about it. Here's the thing, before we get started, I do want to say this. This episode is not intended to give financial advice. It is intended to give education about private capital markets and public capital markets and all the things in between. Please do not take my excitement as any type of subliminal advice for how you should manage your money. But I do like my private capital markets. I just find it so entertaining and thrilling, and people are out here winning in it. So I'm excited. Okay, let's talk about the first thing. If you don't work in finance, you might not know what I talk about, what I mean when I say public capital markets or public financial markets. The thing about finance, there are a lot of synonyms, a lot of language, a lot of nomenclature, and all of that language can be intimidating for someone that doesn't work in the space. And that's another reason why I wanted to start this podcast. And so I'm going to try to use them all and try not to speak jargony, but I also want you to feel comfortable with the language, because once you feel comfortable with the language, you'll realize like, oh, that girl, I know what that means, right? Then you'll feel a little bit more comfortable with the concepts that we go over. All right. So public markets, public financial markets are the markets where anybody, all of us, have access to. We have access to trade or buy or sell or whatever. And those securities or financial instruments that we get to trade are basically stocks and bonds. You see what I did there? Public markets is the stock exchange. Basically, it's the same thing, right? Securities, stocks, bonds, it's a security. You see what I'm saying? I'm gonna use all these different words that all mean the same thing. The public markets are where you and I get to go on Robinhood or E-Trade or Charles Schwab or wherever we like to do our trading and buy stocks and sell stocks and bonds. So yeah, that's all it is. It's nothing crazy. And so a stock, for those who, I'm just keeping it real basic today. A stock is a piece of a company. So I'm totally into jigsaw puzzles, and I like 1,000-piece jigsaw puzzles because they're challenging or whatever. And so imagine a company is like a massive jigsaw puzzle, and they have 1,000 pieces. You can have 100 pieces all the way on up to tens of thousands of pieces. But let's just say our company that we're going to buy from is a jigsaw puzzle of 1,000 pieces. You can buy from me 3 pieces, 3 stocks. And so you have 3 stocks or 3 pieces in my jigsaw company puzzle pie, right? And so that's all a stock is. A stock is just a piece of a company. And the size of your piece depends on how many stocks are issued. How many pieces did the company offer to the stock exchange? They're going to keep some at home. They're not selling 100% of their stocks because they keep some for the people that work there. And they also have some for investors. And then they have some that are sold on the free market. And so that's what a stock is. It is a unit, a piece of a company. And bonds, for the longest time, I didn't know what a bond was. I really didn't. I didn't fully get it. And we're going to have an episode on bonds as well, especially how they relate to the interest market and why they behave the way that they behave when the interests go up and down. But the easiest way to think of a bond is it's literally a loan. When you buy a bond on the public markets, you are issuing a loan to a particular company. So companies who decide that they want to raise money, they can raise it by either issuing bonds so that you all, the public, John Q. Public, can give them a loan, or they can issue equity or ownership. That's what equity means. Ownership of their company by issuing stocks. Stocks equals equity equals ownership. Bonds equals loans equals debt. Those are the primary instruments in the public markets. I'm not going to talk about commodities and futures. I'm not talking about options today. I'm not talking about any of that. Those are just different ways of trading stocks or bonds. You know what? Here's actually something that's very important for you to recognize. While the stock exchange and trading equities and the public financial markets have been around for over a century, a lot of what we do today is new, right? IRAs, new. 401ks, new. And by new, I mean less than 50 years old, right? It's new. And so for decades, the financial advisors would tell you that the best way to construct your portfolio, and portfolio are how you invest all the things that you invest in, is to have 60% of your investments be equities or stocks, and 40% of your investments be bonds or loans that you make to companies. And the reason why is because stocks tend to go up and to the right over time, and they grow a nice safe number between 8 and 12% a year. There are down years, but over time, the average growth rate is between 8 and 12%. And bonds are relatively safe, and they just trudge along at around 3-4% a year. And so financial advisors believe the combination of those two things provide a safe and stable investment portfolio that will grow over time, but won't have you losing your shirt. But the problem with that portfolio of 60-40 is that things have changed. Interest rates are at historic lows. And so that means that bond values and prices, their returns are much lower than 4%. Maybe they're only returning somewhere near inflation, right? And so you're leaving money on the table, perhaps. You have almost half of your portfolio invested in bonds. And when the market is very volatile, so back in the day, stocks and bonds moved asynchronously. They moved in opposite directions, right? So when stocks were really high, bonds were low, but that was cool because you were making a lot of money in stocks. And when stocks were low, bonds were doing pretty well. So you weren't like losing all the things with it, right? But today, in light of the interest rate environment, they don't move as separately as they used to. So in recent years, I would say the last 15 or 20 years, wealthy folks have modified that investment portfolio formula quite a bit, considerably, right? So if you look at ultra high net worth individuals, and those are individuals who have a net worth of at least $30 million. 81% of ultra high net worth individuals invest at almost half of their wealth in the private capital markets, right? So let's talk about that. What are private capital markets? Private capital markets is everything that's not public. So you know how we talked about public stocks, bonds that you can trade online that we all get access to? The private capital markets is the opposite of that. So any investment that you make that you can't get access to on a stock exchange is an alternative investment or an investment in the private capital markets. Remember, we talked about synonyms. Private capital markets equal alternative investments. And what are some of the alternative investments? Alternative investments is, like I said, it's everything but stocks and bonds that you can trade in the public market. So your venture capital, your private equity, your commercial real estate, investing in infrastructure, investing in natural resources, oil and gas, or trees, or clearing the Amazon, sports memorabilia. Everyone has heard of trying to buy anything that Kobe owned. It's going to be very expensive. Part of the reason why OJ got in trouble because he was trying to get his Heisman back or whatever because he knew how much it was worth. Movies. I love this example. Every time a movie is made, it is its own venture. So someone has to raise all the money to fund this venture, and then they have to hire all the people, and they have to produce the thing, and they have to hire all the actors and hire all the people who hold the cameras and the cinematographers and the DPs and all of that. They have to pay to distribute the movie. Like there's a revenue sharing model that generally is created as a result of putting it in the movies and all this stuff. They have to pay to market the thing. And so all of that, creating a movie is a venture. Fine art is an alternative investment. When you buy a Basquiat, or my favorite rapper. I don't know if he's your favorite rapper, but Jay-Z talks about that often. All of the art that he invests in appreciates in value. Buying wine or barrel, like whiskey barrels and stuff like that. Those commercial real estate. All of those things are anything that you invest in that theoretically should appreciate in value, will be worth more tomorrow than it is today, is an investment, is an alternative investment, as long as you obviously cannot get access to it on the New York stock or on a stock exchange. Another alternative I forgot to mention was crypto. It's an alternative, even though you get access to that, you do get access, public people get access to it, but it is considered an alternative, so that's an exception. And so yeah, ultra high net worth people, 81% of them are putting 46% of their money in alternatives, in some type of alternative investment. And the reason why they're doing that is because of diversification. We talked about how stocks and bonds are not necessarily moving and in opposing ways as they used to. People invest in alternatives because of the added diversification benefits. Theoretically, depending on which alternative you invest in, does not move synchronously with the stock market, right? If you invest in a movie, or you invest in a piece of art, or even a particular potential type of company, it's not necessarily going to move if there's a drop or whatever in the stock market. That doesn't mean that that alternative investment will be impacted in the same way. So that is one of the reasons why people like to invest in alternatives or the private capital markets. Another reason is because of the chance for outsized returns. If we think about venture capital or private equity, a lot of value is created before a company goes public. And I love to use Uber as an example for this. I have a lot of classmates who worked at Uber before they went public and retired in their 30s when it went public, because the value that they were able to derive in Uber pre-IPO while it was a private company. And this doesn't mean that this is not every situation is going to be like this, but a lot of these companies squeeze out a ton of value and then they end up going public when there's just literally nothing else to do, right? Like they're like, okay, I guess let's get more money. So what does this mean for you? This means that because the world has changed so drastically, I don't want you all to get left behind. And so I said this before, that the way we invest and manage our money, it shouldn't look exactly like the way our parents did it, right? And so our parents probably, if they talk to you at all about this, believed that the 60-40 stock bond split was appropriate, the end all be all, everyone should do it. And that's not the case anymore. The world is different. There are a lot of different opportunities. There are a lot of different ways to make money. And so my recommendation to you is to get curious about what those different strategies are. But really, the second piece to that is know thyself. I need you to understand what your risk tolerance is and what your goals are. And that will determine what strategy you should be employing in your own investment life and how you should be managing your money. We learn from the wealthy, but we don't blindly apply what they do to our own finances. So we know 80% of them are like, yo, this alternative investment thing is a thing, right? They are putting their money there. So I think that's enough for you to do the research to figure out if it makes sense for you, but it doesn't mean it automatically does make sense for you and you need to do it. But if you decide, yes, I would like to step my pinky toe in the private capital markets, there are a lot of platforms now that will enable you to do that research. There are angel investment groups. There are different platforms, like literally you can Google, like, I want to invest in commercial real estate. I want to invest in venture capital. I want to invest in private equity. I want to invest in fine art. I want to invest in music. Whatever your jam is, there are platforms that will be there that will allow you to do it. My recommendation, do your research, talk to people, as many people as you can, to figure out what their experience has been with that particular platform. Chat GPT it, but Google it. See if they've been in the news, good or bad, and take that information and figure out what works best for you, okay? The key is to educate yourself and diversify your wealth. That's the key. That's the takeaway. That's the quote. That's it. That's the tweet. I guess we can't even say that anymore. Anyway, so I hope you enjoyed today's podcast where we really kind of just dug in a little bit more about private capital markets and public capital markets. Next week, we're going to dig in even more on the two, and I'm going to spend some time really breaking down why you need to care about private capital markets and why it's not just some far off thing that the wealthy people are doing, and it's something that you really need to spend some time researching and understanding what it is you should be thinking about. And yeah, I hope this episode was helpful. If it was, please share it with a friend. Also, like and follow and subscribe wherever you get your podcast, Apple, Spotify, YouTube. That's where we live. And I love this stuff, and I love this for us, that we're learning and growing together and we getting our bread up. Yes. Until next week. Bye.